Well, speaking of numbers, Narayana Healthcare in the spotlight. Let's understand the fine print then. And joining in on the show right now is Sandhya J, the Group Chief Financial Officer at Narayana Health. Thank you so much for taking time out. Just going by your overall numbers, they've been in line, but it's the India business where you've seen your revenues come in a little bit below on account of the lower footfalls. So, what is the outlook then on this particular metric for Q4 and down the line?
Good morning. Thank you for having me here. Indeed, as you are already aware, uh, Q3 is a lean quarter for most of healthcare businesses. For us, Q3 also came in lean when compared to the last quarter. Year on year, of course, we have posted reasonable growth. As far as specifically the India business is concerned, there are a few factors that came to play. One, we saw a relative underperformance in our north and west regions, especially in the north. It came in to some extent because there were some challenges in Gurugram that we are still overcoming, but largely because we had certain policy changes which the government undertook in RGHS in Jaipur. And that had an impact in our overall performance because there were certain segments of the business that we were catering to which became completely unviable. So that is one aspect. Having said that, the other far more conscious aspect, which I want to highlight, is that we've taken conscious measures in terms of moderating our payer mix. You could see that we have delivered almost a 2% improvement in the preferred payer mix in a way. Um, it has helped us manage our margins better. So you could see that in a quarter where overall revenue was muted, we were still able to deliver a good margin profile. And that was because we were very conscious in terms of the payer profile. Finally, we also had some tail rationalization, which we did with our MS Ramaya Hospital and Bellary Hospital. That also had a little bit of impact. So, in terms of the underlying trend for the business, we are seeing healthy footfall. We will see growth from where we are. So, we don't see any much of a concern there. But we do want to call out that we will continue to keep working on payer mix.
Sandhya, I could see that there's a very impressive improvement in gross margins, and that too in a lean quarter, by the way. So that brings me to the question that a lot of hospitals, we understand the well-managed ones like yours, is it a case developing that the operating costs have a kind of a good containment for visible future, because the operating costs, especially the doctor's cost and specialized staff costs, are not going up in the same proportion the way the environment was few years back. Do you see that this part of your overall cost under good control, at least for visible future?
I wouldn't completely say yes, because there are a few factors at play. One is the impact of inflation. So we have constant pressure on inflation of inflation in terms of our input cost, and also in terms of our manpower cost. The minimum wages increase that we've been taking across different geographies. Also, the impact that we're taking on power and fuel. Every state has found a way to increase power and power cost, and that's coming on. A lot of the cost efficiency that you are seeing is not because costs are flat, but we are trying to be more efficient. So I don't think we've just to give a comparison. I don't think we've meaningfully added a single bed in the past several years. However, we've been delivering top line growth. Similarly, we've not added significant manpower at all in the past several years, despite the growing revenue. The reason we are able to do this is one, because of the way we've looked at technology as an integral part of how we run our business, and therefore we are using technology to be more efficient in our processes. And of course, what we've spoken about earlier, our focus on throughput. So that's really helping us rationalize the cost. If I look at absolute inflation, it's crazy, I should say.
Interesting. So speaking of that, give us an insight as to what the outlook will be on your gross margins. They have increased sequentially, and give us an outlook as well in terms of your debt reduction plans, because you have seen the finance costs impacting the bottom line.
Yes. So from a gross margin point of view, while we don't guide numbers, I think we are on a good path to be able to build on to whatever we have done so far. And therefore, I'm seeing that to be a positive trajectory. But like we've always said, we do not have a very aggressive margin expansion plan. It's very organic, linear, and we do it without creating too much pressure on the price for the customer. So therefore, it will be slow but steady. As far as our debt is concerned, right now we have a negative net debt, which means our cash balances are more than our current debt. Having said that, we will significantly borrow going into the next 2 to 3 years. We've announced expansion plans. We are looking at greenfield capacity build up in Bangalore, Kolkata, our flagship centers. And therefore, there is going to be an aggressive expansion of debt for the next 2 to 3 years. However, we will try to keep our ratios like debt EBITDA in a acceptable and reasonable way.
The other thing I wanted to understand was, your distribution arm, which is for medical supplies, commenced operations in the month of December, right? Very recently, as we understand. What is the growth potential here, and where do you see this business, say, in the next 1 to 2 years, or maybe even 5?
Actually, for all practical purposes, you can ignore that business because it's just moving costs from one bucket to another. We are just trying to be more efficient in terms of our supply chain. So we want to be being able to hold reduced inventory, be able to move inventory around our units because we operate across multiple legal entities. And therefore, it's more efficient to operate from a distribution arm across legal entities. So it's really an operational enabler. So you don't have to read too much into our distribution entity or factor anything from that perspective.
Okay, and what about your Capex plans? Any new fundraise plans on the anvil that you have?
Indeed, like I've mentioned, we have very aggressive capex plans. We are coming out with a NCD raise soon, and we will also be raising a bank borrowing to fund our capex ambitions. We will aggressively spend the next 2 to 3 years to create capacity, especially in our flagships where we reached that stage that we have to start building capacity, and you will see a lot of activity from us in that space.
Sandhya, the new region which you have actually moved towards north, etc. How are the utilizations panning out in your new facilities?
It's a mixed bag, actually. We have they are not as high as our flagships or our older locations, where we have no capacity left, and we've managed completely through efficiencies, throughputs, reduced day loss, and that kind of efficiency levers. It's not like that we do have surplus capacity in our north and west regions. But we are also very conscious on the payer profile and the type of business that we want to onboard. And therefore, we maintain that balance. It has been a slow growth segment for us. And turnaround, we've turned around, of course, but it has not been as aggressive as we'd have liked it to be. So we have little more work to do on the north and west zones.
Okay, thank you for joining in and sharing with us those milestones as well as all of the updates on the business. Good to
Thank
have
you.
you on board.